You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
If you wait until you are 35 to start investing, you haven't just lost 10 years of time.
Right. It's much worse than that.
You have quite literally cost your future self over $3 million.
Yeah, the math is just brutal.
It really is. That is the mathematical reality of starting late. And today, we're going to make sure that doesn't happen to you.
Because right now, your personal finance dashboard is probably blinking with like 1,000 different warning lights.
Oh, absolutely. You've got people yelling at you about crypto, others demanding you buy real estate. Meanwhile, you are just trying to figure out how to put a little money away each month without, completely ruining your current quality of life.
Right. The barrier to entry isn't a lack of information anymore. It's information paralysis.
Yeah, there's just too much of it.
Exactly. You have these massive institutional theories clashing with the psychological reality of actually parting with your hard-earned cash. People freeze up because making the wrong choice feels catastrophic.
Okay, let's unpack this. To get you a custom-tailored, completely jargon-free roadmap for getting started in 2026, we are synthesizing 4 distinct sources for this deep dive.
And they offer a really great mix of perspectives.
They really do. First, we have a highly practical step-by-step beginner's plan from ATI. Then we have the comprehensive, really aggressive wealth-building philosophy from Ramsey Solutions.
A classic.
Right. We are also layering in age-based allocation strategies from U.S. Bank. And finally, to keep us grounded in reality, we have a very candid personal essay from a 25-year-old NerdWallet writer sharing their exact, messy, real-world process.
I love that NerdWallet piece. The value of this specific stack of sources is the contrast. You get to see the strict, unyielding math from the institutional side tested against, the behavioral realities of a young professional.
Someone just trying to balance future security with going out to dinner on a Friday night.
Exactly.
Well, the paradox of investing is that the very first step the math demands of you isn't investing at all.
No, it's not.
Before you can expose your money to the stock market, you have to financially insulate the life you're living right now. Every single source we are looking at draws a hard line here. You must establish a safety cushion before buying a single stock.
Yeah, both ATI and Ramsey Solutions are incredibly adamant about clearing the deck first.
Right, like Ramsey's baby step 3.
Exactly. Ramsey's framework dictates that you must pay off all consumer debt. So credit cards, auto loans, personal loans, and fully fund a 3 to 6 month emergency fund.
No exceptions.
None. You do not direct a single dollar toward the market until that is complete.
And ATI actually gives us the specific math on this. If your baseline survival number, like rent, groceries, basic utilities, is, say, $1,000 a month, you need $3,000 to $6,000 sitting in a liquid savings account.
And that's where the NerdWallet writer's experience comes in handy.
Yeah. They shared that they use a high-yield savings account, or HYSA, for this exact purpose. Current rates in 2026 are hovering around 3 to 4%.
Which is pretty decent for just cash sitting there.
Right. So parking $5,000 in a HYSA at, let's say, a 3.5% interest rate generates about $175 a year.
Yeah.
Free money.
It is, but, the yield is really just a minor perk. The underlying mechanism is liquidity.
Accessibility.
Exactly. This account acts as a financial shock absorber. When you hit a pothole, a blown transmission, a medical emergency, the cash takes the impact so the chassis of your broader financial life doesn't snap.
It's like the seatbelt in a race car. You just don't hit the gas until you are securely strapped in.
That's a great way to look at it.
But hold on, though. I have to push back here. And the NerdWallet writer even admitted they felt this way. Inflation is a real factor.
Oh, for sure.
If I have $6,000 just sitting in a savings account yielding 3% and inflation's running at 3 or 4%, that money's basically just treading water. Maybe even losing purchasing power.
Yeah.
Doesn't holding that much cash essentially mean throwing away potential stock market gains just to feel safe?
What's fascinating here is that viewing that cash through a purely mathematical lens of optimization misses the behavioral finance angle entirely.
How so?
Well, that safety net is not designed to generate wealth. It is an insurance policy for your actual investments. The stock market is inherently volatile.
Right, it goes up and down.
Constantly. So if you skip the emergency fund, put all your cash into stocks, and then, God forbid, lose your job during a 20% market downturn, you have a massive problem.
Because you'd have to sell your investments just to pay your rent.
Exactly. You are forced to liquidate at the absolute worst possible time. You lock in a 20% loss just to survive.
Ouch.
Yeah. The cash in the high-yield savings account prevents forced liquidation. It gives you the behavioral fortitude to simply let your investments ride through the turbulence because your immediate survival is already funded.
Okay, that makes a ton of sense. So the shock absorbers are installed. Consumer debt is gone. The foundation is insulated.
Now we can finally start talking about horsepower.
Yes. The immediate question for you, the listener, is determining the actual dollar amount to commit to the market every month. And the philosophies in our sources diverge sharply on this.
They really do. The divergence centers around intensity.
Ramsey's pretty intense.
Very. Ramsey Solutions preaches dedicating a strict 15% of your gross household income to retirement. And this isn't like a loose guideline, it's a hard rule.
Right. It takes priority over paying off your mortgage early or even saving for a child's college fund.
Exactly. 15% non-negotiable.
Here's where it gets really interesting. ATI counters that with a much more approachable starting line.
Yeah, they're a bit more gentle.
For someone making around $2,000 a month, they suggest earmarking 5 to 15%, which is a relatively painless $150 to $250 a month.
Which feels a lot more doable.
It does. But I mean, if I'm staring at a massive retirement goal, doesn't $150 a month feel like a drop in the bucket? Like, how does that actually move the needle compared to Ramsey's aggressive 15%?
It moves the needle because of the underlying mechanism of exponential compounding.
The eighth wonder of the world.
Right. We often hear the phrase compound interest, but humans are frankly terrible at visualizing exponential math.
We think linearly.
Exactly. 1 + 1 = 2. But your investments don't grow in a straight line. They grow because your principal earns returns, and then those returns generate their own returns, compounding on themselves year after year.
So the back half of the timeline is doing all the heavy lifting.
Yes. The vast majority of your wealth is generated in the final decade of your investing horizon. ATI's math actually proves this out.
Let's hear the numbers.
Investing just $200 a month at an 8 to 9% average return over 30 years grows to roughly $367,000. And here's the crazy part. The actual capital you contributed out of pocket is only $72,000.
That's wild. So the remaining $295,000 is purely the result of time amplifying those returns.
Pure time and compounding.
That brings us right back to the horrific cost of waiting, which the Ramsey source illustrates with a hypothetical investor named Jane.
Oh, poor Jane. Well, or rich Jane, depending on the scenario.
Right. So Jane starts investing $500 a month at age 25. Assuming an 11% return, she hits $4.3 million by age 65.
A massive nest egg.
Even if the market only returns 7%, she still hits $1.3 million. But if Jane delays just 10 years starting at 35 instead of 25, she loses millions of dollars in potential wealth.
She loses it because she chopped off the most explosive part of the exponential curve.
The end of the timeline.
Exactly. This is why agonizing over whether you can afford Ramsey's 15% versus ATI's $150 is the wrong focus for a beginner.
Oh.
Yeah. The sheer volume of your initial capital is drastically less important than the immediate formation of the habit. Automating a small contribution forces your capital onto the timeline early, allowing compounding to do the actual work.
Just get in the game.
Get in the game.
Okay, so the money is budgeted. We're in the game. But now we hit the structural wall where most beginners, myself included back in the day, completely freeze up.
The alphabet soup.
The alphabet soup of accounts. 401k, Roth IRA, traditional IRA, HSA. You have this money earmarked, but where does it physically go?
The terminology is definitely dense, but Ramsey provides a structural hierarchy that cuts right through the noise.
That's the rule.
Match beats Roth beats traditional.
Match beats Roth beats traditional. Let's break down the mechanics of that hierarchy. Match refers to the employer 401k, which the NerdWallet writer heavily utilizes.
And for good reason.
Right. If your company offers a 3% match and you put in 3% of your salary, they match it. It is a 100% immediate risk-free return on your investment before the stock market even opens.
It is literally the most efficient money you will ever make. Do not leave it on the table.
Now, a standard 401k operates on a traditional tax structure. That means the money you contribute goes in pre-tax.
Right, so it lowers your taxable income for the current year.
Which is nice now. However, the trade-off is that when you are 65 and start withdrawing that money, every dollar is taxed as ordinary income.
You are sharing your future harvest with the government.
Which brings us to the second tier of Ramsey's rule, Roth. Specifically, the Roth IRA.
This is a fan favorite.
It really is.
Yeah.
This operates on the exact opposite mechanism. You fund a Roth with after-tax money. So you've already paid the income tax on your paycheck.
You take the immediate tax hit today.
Right. But the capital grows completely tax-free, and you withdraw completely tax-free in retirement. You keep the entire harvest. U.S. Bank highlights that a Roth is uniquely powerful when you are in your 20s.
The logic there is based on your career trajectory. In your 20s, your earning power is generally at its lowest, meaning you are in a lower marginal tax bracket. So paying taxes at today's low rate to secure decades of completely tax-free compounding is a massive mathematical advantage.
And we should note the 2026 limits. The contribution limit for a Roth IRA is $7,500, whereas a 401k allows up to $24,500.
Good distinction.
Rounding out the vehicles, we have health savings accounts, or HSAs, which are essentially triple tax-advantaged accounts for medical expenses.
Very powerful if you qualify.
And 529 plans, which allow tax-free growth specifically for educational costs, like if you have kids. And finally, standard brokerage accounts.
The Wild West.
Pretty much.
Uh-huh.
These have zero contribution limits and zero withdrawal penalties, but they offer absolutely no tax advantages. I think a really helpful way to visualize this ecosystem of accounts is the fridge versus the deep freezer.
Oh, I like that.
Yeah. A brokerage account is your fridge. It's highly accessible for near-term goals, say pulling out cash in 7 years for a down payment on a house. The 401k and the IRA are the deep freezers. You lock that capital away for decades in exchange for those massive tax benefits.
The tax code is essentially bribing you to leave the money alone until you are near retirement age.
But, and this is a big but, the NerdWallet writer explicitly struggled with this. They wrote about feeling a deep reluctance to lock all their disposable income away until they're elderly.
Which is such a human reaction.
Totally. If you are 25, the idea of barricading your wealth behind a 60-year-old age requirement feels suffocating. You want to buy property, start a business, or, I don't know, take a sabbatical long before retirement age.
That tension between present optionality and future security is the core struggle of personal finance.
So how do we fix it?
The solution isn't pelling one or the other. A robust financial strategy utilizes a fleet of vehicles.
A fleet, okay.
You fully fund the deep freezers, the tax-advantaged retirement accounts to guarantee your ultimate financial independence. But simultaneously, you build up the flexible brokerage accounts to act as a capital bridge for your 30s and 40s.
So what does this all mean? We have our budget, and we've selected our fleet of tax-advantaged accounts. But opening an IRA and putting cash inside it does absolutely nothing.
Yep, it just sits there.
The account is just an empty bucket.
Yeah.
The final critical step is deciding what to buy inside the account. What is the actual engine generating the returns?
And here is where the universal consensus across every single source comes in. The absolute rejection of single stocks.
No picking the next Apple or Tesla.
Never. Beginners should never attempt that. The risk profile is asymmetric in the worst way. The mechanism to survive market volatility is broad diversification.
Buying fractional ownership in thousands of companies simultaneously.
Exactly.
But the strategy for achieving that diversification is where our sources engage in a massive philosophical debate. We are essentially looking at three distinct methodologies.
Let's hear them.
First, the NerdWallet approach. Target date funds. This is the ultimate set it and forget it mechanism. If you plan to retire in 2065, you literally just buy a 2065 fund.
And an algorithm automatically calibrates your risk exposure over time.
Right. It holds aggressive, high-growth equities while you are young, and as you age, it systematically sells them off for stable, fixed-income bonds.
The mechanism there is purely automated risk mitigation. It's beautiful in its simplicity.
Then we have ATI's approach, which champions low-cost index funds. An index fund doesn't try to outsmart the market. It simply buys the entire market.
It has a brilliant self-cleansing mechanism.
Oh, explain that.
If you buy an S&P 500 index fund, you own the 500 largest U.S. companies. If one of those companies starts failing, its market cap drops, and it is automatically ejected from the index and replaced by a growing company.
The garbage takes itself out.
Exactly. ATI suggests a simple split. 60% in a broad stock index for growth and 40% in a bond index for stability.
On the opposite end of the spectrum, we have Ramsey's active approach. He explicitly rejects passive index funds.
He's very vocal about that.
Very. Instead, he advises buying 4 actively managed mutual funds: growth and income, growth, aggressive growth, and international.
So the mechanism here relies on paying a professional fund manager to actively research, buy, and sell individual stocks with the explicit goal of beating the market average.
And layered over all of this is U.S. Bank's perspective on asset allocation over time using the rule of 110.
This is a great rule of thumb.
You subtract your age from 110 to determine your equity exposure. At age 25, 85% of your capital is in volatile stocks for maximum growth. By age 65, you shift the mechanism, dropping to 45% stocks, heavily relying on bonds and cash to preserve the wealth you've built.
But we really have to address the friction point between Ramsey's active management and ATI's passive index funds.
The fees.
The fees. Actively managed funds charge a premium, often around a 1% expense ratio, to pay that manager's salary. Index funds are entirely automated, often charging less than 0.1%.
But if I'm a beginner, why should I care about a 1% fee?
Right.
Honestly, it sounds completely negligible.
The math behind fees is arguably the most insidious part of investing, because fees compound just like returns do.
Well,
Yeah, think about it. If you have $100,000 invested, a 1% fee is $1,000. That doesn't sound catastrophic.
terrible.
But over 30 years, you aren't just losing $1,000 a year. You are losing the exponential growth that $1,000 would have generated if it had stayed in your account.
It's the Jane example all over again, but with fees.
Exactly. Over a standard investing lifetime, a 1% fee difference can literally devour hundreds of thousands of dollars of your potential wealth.
That is staggering.
It is. This is the philosophical tension you have to resolve. Are you confident that an active manager can consistently beat the market by a wide enough margin to justify their compounding fees?
And what does the data say?
The historical data suggests that over a 30-year horizon, the vast majority of active managers fail to beat a simple index fund.
So it comes down to your personal bandwidth and your desire for optimization. If you use ATI's passive index fund approach, you have to log in manually once a year to rebalance your 60-40 split because market shifts will skew your ratios.
Which takes a little discipline.
Right. But if you want zero friction, you buy the NerdWallet Target Date Fund and let the algorithm do the rebalancing, accepting a slightly higher fee for the convenience.
Ultimately, the optimal portfolio is useless if you abandon it. The best mechanism is the one that removes your behavioral friction so you can consistently feed capital into the market.
Well, we have dissected a massive amount of financial architecture today. If you're listening to this, here is your definitive 4-step playbook for 2026.
Let's recap.
Step 1. Install the shock absorbers. Park 3 to 6 months of living expenses in a liquid high-yield savings account so a flat tire doesn't force you to liquidate your portfolio.
Crucial.
Step 2. Define your horsepower. Pick a monthly dollar amount, whether it's Ramsey's aggressive 15% or ATI's $150, and automate it.
Set it and forget it.
Step 3. Pick your vehicle. Claim the 100% return of your employer 401k match, then push the rest into the tax-free compounding environment of a Roth IRA.
And step 4.
Step 4. Install the engine. Avoid single stocks, keep your fees ruthlessly low, and buy broadly diversified index funds or target date funds.
The architecture is incredibly sound, but, theory is useless without execution.
True.
I want to leave you with a concept inspired by the U.S. Bank strategy. In their guidelines, they recommend that when an investor hits their 60s, they should do a test run of their retirement income to ensure the math actually supports their lifestyle.
Make sure the money lasts.
Right. But we can adapt that mechanism for the very beginning of the journey.
A beginner's test run. How does that work in practice?
If the idea of locking up 15% of your income terrifies you, run a 30-day simulation. Next month, the moment your paycheck clears, immediately transfer 15% of it into an obscure separate savings account.
Out of sight, out of mind.
Exactly. Do not invest it yet. Just remove it from your immediate ecosystem. Try living for the next 30 days as if you genuinely took a 15% pay cut.
That's a fascinating experiment.
If you reach the end of the month and you paid your rent, bought your groceries, and lived your life without a catastrophic drop in your standard of living, you have just dismantled the primary psychological barrier to investing.
Because you proved you could do it.
You have empirically proven that securing your future wealth is entirely supported by your current cash flow.
You realize the margin is already there.
Yeah.
You don't have to sacrifice your present life to fund your future. You just have to direct the flow of the capital.
Precisely.
The chassis is protected, the engine is built, and the roadmap is incredibly clear.
Now take the first step.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.